Real Estate and Mortgage Show, your go-to spot for everything home buying, selling, and financing on News Talk 580 CFRA.
Welcome to the show, everybody.
We are back.
Buenos dias.
Oh yeah, Frank's fresh from Spain,
from Barcelona.
And
amazing how like last week you were on the show.
Yep.
And in this short span, you've been to Spain and back.
Business. Yep.
Wow.
With a lender and Sagen as well, who's one of the default insurers. It was nice to be able to get together with Ivy and Jim, who were on the trip with us. And you always take time. I mean, as much as there's a lot of fun events, but you're always sitting at either lunch or dinner and you're talking business because we're all in that business. So we all talk about it. So it's interesting to hear Jim talk about the fact that Toronto Star published a report this week where delinquencies are up in mortgages. And then, of course, you were at the event here in Ottawa on Wednesday, the Simba Symposium, where Greg Casey was there from Sagen, also did some amazing stats from what I understand. And but they're up, but nothing to be overly concerned about. But again, anytime that something goes up like that, people all automatically start to think the worst. And it's far from the worst when we've got 0.36 of 1%.
Yeah, it's less than 0.5%.
Yeah.
Sorry, run that number again, Frank.
0.36 of 1%.
Is that Canada, Ottawa, Ontario?
That is Ontario's 0.36, most of them in the GTA area.
Yes.
So they're really focused on GTAs. You've got a lot of condos, right? I mean, you've talked about condos ad nauseum where, they're not – it's a weak part of the market right now. The real estate industry, the condo market is what's weak specifically in Toronto, where they overbuilt them. People were buying them hoping to cash out at some point. Values going up, and then COVID happened. They sold really well in 21, 22. But without people going back to the offices in full force, all of a sudden the investment value went down because a lot of people bought them hoping they can Airbnb them or rent them out.
But think of that. But think of that.
Weaker.
Yeah, but think of that number. Like less than 0.5% of delinquencies. Like that's peanuts. It's
nothing. Too safe. I mean, it's way too safe.
But I must admit, when I was at the conference, Simba conference the other day, when he put the graph up, it showed the graph like a huge uptick in delinquencies. But it went from 0.1 to
it went from 0.16 to 0.24 in the quarters, and now up to 0.36.
Yeah.
So is it significant? Sure, it is. I mean, there's significant increases, but just to put it into perspective, pre-COVID, that number was 0.28. So, we've gone from 0.28 to 0.36 among all the craziness that we've endured in the last 6 years once COVID hit, where the big spikes and the big drops.
Did they do an Ottawa number or just Ontario?
Well, Greg would have done an Ottawa number.
So if Greg, so his stats were 0.14, I think. That's Ottawa?
That's probably Ottawa that he was talking about.
Which is peanuts. Like
0.14 of 1%.
Of 1%.
Of mortgages go delinquent in Ottawa.
Yeah, and so I would think, if you just circled in Toronto, Toronto is a huge part of that.
Yeah, no question.
Huge
right?
part. And the condo market, like you talked about, is horrible in Toronto.
That and Brampton. I mean, according to what most lenders and default insurers tell us, the issues in the Toronto area are all specific to condos and Brampton. Where in Brampton,
I saw that headline this week that Brampton was
why Brampton?
number one in Canada.
Why Brampton? What's going on there?
There was a lot of mortgage fraud committed, or fraud for shelter, I'll call it. So people most people are not missing payments because, again, that number is still relatively low. Mm-hmm. But there was a lot of people that bought those properties. Again, immigrants that bought the properties, and all of a sudden they can't get jobs, or they can't get good enough paying jobs that they can't afford to stay there. There's many immigrants. I mean, our population has dropped over the last 2 years because immigrants have figured out that there is no better life here. It's too expensive to live here.
Way too expensive, yeah.
Especially if you go to GTA. I mean, the cost of living there, whether it's the property itself, the rent or the mortgage itself, and the cost of overall living is just too high. So,
well, what was the average sale price we were talking about? Toronto, 1.1,
1.1, 1.2. The average sale price. It's like
average.
That's equivalent to like a San Diego or like somewhere in California.
Well, you're talking about a $4,000 or $5,000 mortgage payment. So unless you're getting very well paid, very difficult to make ends meet, especially considering the cost of gas and food and everything else that goes with owning a property.
Sure, of course, all the maintenance, all that kind of stuff. Yeah, for sure.
Got it, so.
Now, is that a lot like condos just everywhere, especially GTA, but here in Ottawa are struggling a little bit as well.
Well, condos has been the Achilles heel of our market for probably 2, 3, 4 years. In fact, we could probably go back 7, 8, 9 years. The condo market's always been really tough. And I think one of the biggest things with the condo market is the variable of condo fees, right? So, you could have a brand new building. Condo fees are, let's say, $50, $60, $70, 70 cents a square foot. So you're looking at, maybe $500, $600, $700 a month in condo fees. But that's starting out. In year 2, that could go up to $800, $900, $1,000. You're at the
special
mercy.
assessments.
Special assessments, older buildings with special assessments, balconies starting to go, roofs starting to go. Like the variable of a condo fee is the toughest part because you're at the mercy of the building. Yeah. And I know everyone shares those condo fees, but the problem is it's such a variable that the condos are they've always been a bit of a struggle, right? Like I know it's great to get first-time home buyers into some of the cheaper condos in the 3s and the 4s and the 5s, but you never know with the condo fees. And sometimes you're better to buy something that doesn't have condo fees that's a little bit more expensive. Freehold, something like that. And you'll say that too, Frank. Like what when someone comes in and says I'm buying this condo, it's only $400,000, but condo fees are $600 a month.
Well,
are they better to buy a townhome in suburbia?
You're better off to buy a townhome for $550 because your monthly cost is going to be identical. The question is, do you have enough of a down payment to qualify for the $550 on a freehold? Because on a condo, what happens with condo fees is we only use 50% of the condo fees for qualifying. So if there's $600, it's only $300.
Yeah.
So.
Sorry, I'm confused by that. Why?
Because some of the condo fees are things that would normally not be usually calculated inside of a traditional mortgage. So therefore, usually condo fees incorporate landscaping, and that doesn't have a cost to it if you had a freehold, as far as the lender's concerned. So that's why they only use the 50%.
Okay, that makes sense.
And then there's some condo fees that include heat, so therefore...
you don't have that utility expense.
We don't have that, So if a condo fee includes heat, then that's great. That's why we use 50%. But if it's a freehold, we have to use usually about $100 a month for heat as well to qualify. So, that's the reasons behind it.
It'll be interesting when the May numbers come out to see. I mean, we should get those
by next week.
By next week, I'll have the numbers. But you look at the end of April, our condo market number of sales was down 17%, which is drastic. The townhome market number of sales was up. The single-family homes was down a little bit, but the condo market has just been our Achilles heel.
Right. Now, is that caused by a lot of speculation in that market?
Yes and no. So over the years, when people are buying condos, they're buying them sometimes 2-3 years in advance.
Icon.
Right? Yeah. So you're buying them well in advance, and a lot of people speculate to maybe have them as an investment property, and then by the time the condo's ready and you have, let's say, I don't know, 20% of the building that are investors, they put them up for rent. Well, supply and demand. Like if you have 30, 40, 50 units for rent, the prices have to come down. And I just think over the years, the condo market has always been, it's been a while now. It's probably been a decade that our condo market's been beat up a little bit, but the last couple years has been probably the worst we've seen in the condo market right now.
Right. I was thinking about that. I came across this in a forum this week. This person was just asking, they're saying, I'm a first-time home buyer eligible for the rebate, planning to buy a new 5-bedroom detached house from the developer, which costs about $800K after the rebate. But I'm reluctant to buy. They were just asking this in a forum. Can anyone provide expert opinion on what the price of this home will be after 3 years, keeping in mind the housing demand crisis, interest rates, economics, et cetera?
Well, it all depends where it is, right? It's hard to...
This was off an Ottawa thread.
Yeah, so it's hard to know. And also, we talk about the rebate. The rebate's not set in stone yet, right? So I know, and there's so much out there. I mean, I know people are listing homes with rebates included. Builders are now listing homes with rebates included. But the truth is, the rebate is not included yet. So it will be, but as of right now, it's not.
So what struck me about this question specifically was it felt very much like speculation. Mm-hmm. Like this person is thinking about this place, getting it, and then thinking of flipping it in 3 years.
You think? To me, I would take that question and I would look at it and say they're nervous about the value being down by $100,000. So, 3 years from now, real estate, Paul will be 1,000% behind this. real estate is a long-term play.
Long-term,
It is not short-term play. You could get lucky and make money in a year or 2 or 3 years, but realistically, if you look at what it costs to get into a home, the moving, the land transfer tax, and everything that goes with it, you're really, unless you're buying a fixer-upper and you're a renovator and you're going to go in there and you're going to put some work into it and make some money that way. Even then, I can tell you, a good friend of mine just did it. By the time he paid the HST, he paid everything on it. He goes, the government made more than I did. I'm not sure that I want to do this again because my profit margin was very, very little compared to what the government should be enticing me to do this because they made way more than I did. So, for someone who's buying it and looking 3 years out, I think the one thing we both agree, all three of us probably agree on, is the fact that Ottawa is a very consistent, stable real estate market. Outside of COVID, we've always been very consistent. And the likelihood that if you buy this house for what you're getting it, and if you incorporate that HST rebate, which may or may not be around 3-4 years from now, then the likelihood is very high that value of that home should be higher, not lower.
Yeah, it should be. I mean, we've seen consistently, anywhere from 2 to 4% in Ottawa. I mean, obviously COVID was crazy. We went up, 50%, but just bank on a couple percent every single year, 3, 4, 5% every single year, and the value should go up. We went down 2 years ago. Our average sale price went down 5.5%. But besides that, I mean, if you look at what we did through COVID and then you drop that 5.5%, we're still up 50%, right? So, I think and like you said, Frank, real estate is a long-term play. If you're buying real estate to, think about selling it in a year or two, well, who knows what's going to happen with the market?
3 years is not a long-term play.
No. But real estate's a long-term play.
So in a situation like this, how long should somebody consider holding a house?
Well, it all depends on, if you're buying it with the HST rebate, when it does come in and is approved.
Yes.
And you're in a certain area, you're in a good area, you will make money on that property. I wouldn't panic about, what the value is going to be in 3 years. You're not going to be underwater. I can tell you
can't forecast it anyway. Let's call a spade a spade.
Yeah.
You can't forecast it.
Agreed.
You just can't.
Anybody that says they can is full of it.
Yeah.
Agreed.
You can't. Agreed.
Yeah, absolutely. Have a question, head over to realestatandmortgageshow.com or give us a call at 521-TALK, 521-8255. We'll be right back. We're back to the show, everybody. So, Frank, I heard this week, Stats Can, we're in a technical recession.
But doesn't it feel like we're in a recession? To most people,
it's felt like that for like 2 years to me.
Yeah, we've been in a recession for a couple of years, really.
This is not a surprise. For most families, they feel like we've been in a recession for a long time. Just the statistics now certainly show that. It's a little, it's down, but at the end of the day, I'll tell you, travel tourism is still way up.
Is it really?
My God, the amount of people that I saw in the airports, Barcelona was absolutely rocking. And I'm walking with Jim, who I said is CEO of Sage, and I said, everybody talks about this global recession, and we're walking around the street and we're saying, I don't know where this global recession is. It's not here, that's for sure. Look at the number of tourists that are in this city right now. So
I will say, Frank, though, that the gentleman, what was his name, who did from Sagen, who did the...
Greg,
yeah.
Casey.
His stats were very optimistic.
Yes.
Like, they were very up. And I know he's not going to go up there and do doom and gloom and stuff like that, but a lot of his stats when it came to mortgage rates, when it came to unemployment, GDP, all these different stats, they were quite optimistic. And he was very optimistic on what's happening here, so which is good news.
Well, again, he's an insurer, right? So usually insurers could be very pessimistic instead of optimistic.
Aren't they by default?
By default, they are, right? But Greg is more of a realist.
Yeah.
He talks about some of the things that are just in the real world, they relate to the everyday person. So Greg is one of those guys that can just, he takes it all in, he takes all the data in, but then he also adds the fact he sees what real life is all about and doesn't specifically go with just the data. That's why the delinquency ratios don't bother him that much because he knows that they were going to go up, but they're still way, way more reasonable than anybody should expect. Keep in mind, here we are at 0.36, and it's making headline news. In 2007 in the U.S., it was 30%. So here we are. We are so much higher. Canadian banks are the banks came out with their profits as well, and all of them have done very well. They've all increased dividends. So again, the banks are not hurting, even though this number comes out. So go figure. The same week, we see the delinquencies go up, and yet the banks record record profits.
Again.
Well,
so
Yeah,
take it for what it's worth.
Yeah, one thing he was saying, which I was very optimistic about, as at the end of April, like we'll know more in the next couple of days when May numbers come out. I know as a company, our May wasn't as good as what we usually do in May, so we'll see what happens there.
Was it like to last year though?
Yeah, but our April was insane. Like we did 82 deals in April, so I was hoping to do another 82 in May, and we didn't get there, but we did a good number. But in the market at the end of April, our number of sales was down 4.4%. Our average sale price was down 0.4%. He was saying that he expects by the end of the year, we will be in the high single digits for the average sale price, which is optimistic. I mean, if we could end
Ottawa or Ontario?
No, he said Ottawa. So
Ottawa,
if you're like, 6, 7, 8% average sale price, that's, I mean, I don't see it being that high, but his stats were very optimistic, which I loved because he was, there's a lot of people in that room who are, whether you're a mortgage agent, whether you're a realtor, some people are having some tough years, let's be honest. And he was very optimistic, and I think people were happy to hear what he was saying about where he expects the Ottawa market to go, where he sees it going, which is awesome. I was very happy to see that, very optimistic.
Yeah, what was great about this conference is that I happen to be with brokers from across the country. So it's always interesting to hear how they're feeling about the market. And overall, outside of the ones that are in Toronto and Vancouver, most of them are feeling very optimistic, and most of their clients are either in the house buying mode, or if their mortgage is coming up for renewal, they've adapted to the fact that the higher interest rates are something that they were ready for and they're going to be able to cope with. So, but outside of, but that's outside Vancouver and Toronto. Unfortunately, Vancouver, Toronto, when you got an average home of $1.1 million and your mortgage is $600,000 or $700,000, it's impactful if interest rates go from 2% to 4.5%. Like that's massive increase in your payments. Where in Ottawa, because the average mortgage is much smaller, you're looking at $200 a month, which most people can accept. And then you look at other centers across our country. If you're in the Maritimes, the mortgages are so much smaller that even that 2% increase maybe only amounts to $100, $150 a month, which most people can at least live with.
Not inconsequential, but it's not hundreds and hundreds and hundreds of dollars like it would be at a
Toronto. $700-800 a month is significant, and that money's just not sitting around. So we saw the bond market come down as these talks are starting to looks like hopefully this conflict is going to come to an end. We follow the bond markets very closely. We've seen some nice decreases in the last 2 weeks, so we're getting to the point where hopefully if this agreement gets put in place, then we'll start to see these interest rates come down a little bit, because our concern in our industry right now, and I think for Sagen as well and anybody else, the lenders, is what's going to happen next year, because next year is when we hit the peak. Right. Where now, over the next 8 months, I would say, is where people bought at the peak.
Yeah.
Right? So over
Jan,
the next
Feb, March, April 2022.
Was the peak.
Now getting into Jan, Feb, March, April of 2027.
Yeah.
That's your peak.
That's your 5 years right there.
That's the ugly period. That's going to be a tough period. We'll see. We haven't seen the spring market this year. We may not see a spring market next year, because there are going to be a lot of people who might not be able to sell.
Right.
Or have to sell, maybe.
Well, if they're underwater, they can't sell.
That's fair, yeah.
If they're underwater, they can't sell. They have to
You can renew. So people are worried about that, but I will say you make your payments on time, you can renew. It's if you start missing payments where the lenders will come back and say, we don't want you. You got to go find a mortgage somewhere else. And if you're underwater, that's where you're going to have to sell. You're going to be forced to sell. That's the concern in Toronto right now, specifically on the condos. As much as they've come down, the peak was still, they haven't hit the peak yet. And that's their biggest concern there, is that they got to get over that hump, which is probably fall of 2027 before they're finally over the hump, and then they can start looking at things more normal at that point for condos. So that's why I think the condo market's going to struggle in Toronto for another 18 months, probably not do that robust a business here either. But I think the townhomes are going to absolutely, that's where it's at. Yeah, I think it's
the townhouse market. Townhouse market's the only market that number of sales are actually up right now.
Yeah.
I mean, the singles are down, the condos are down, the towns are actually up number of sales. So I do think, too, once this HST rebate comes in and it's firm, I think the townhouse market is going to explode.
This market needs that. Can the governments please, before they go on their prolonged summer holidays that they do, can we get this HST put in stone, have everybody, all the necessary parties, which starts with the builders and the buyers, right to the lenders, right to the default insurers, right to the lawyers. Can everybody please have what they're supposed to do with it? That makes so much sense. And we can't go into the summer with these balls in the air because it's going to hurt the home builders. It's going to hurt them tremendously. And more importantly, it's going to hurt our economy.
Yeah,
it already has. It has. Like, it's slowed down the home building for sure. I mean, I know I work with Clement Homes, and it's slower now because people are waiting. They don't trust what the government's going to do, you know? But let's be patient, guys. It's only been 14 months. Come on, be patient. Be patient.
So you're finding people are a little nervous to pull the trigger.
They're nervous to pull the trigger because they're not sure if it's going to be retroactive, if it's going to go back to the date that they bought it. So they're like, I want to make sure it's firm, and then I'll buy. So one thing we're doing with Clement Homes is we're building at a feverish pitch because when it does come in and it is firm, we have tons of inventory. We're ready to go, right? So
people can get into them.
People can get in, but there's a lot of people right now. We're working with a lot of first-time home buyers and builders and people who are buying new home builds that are just like, we're going to wait. We'll wait. We'll see what happens. We want to make sure it's firm before we do anything.
Well, have a question? Head over to realestateandmortgageshow.com and submit it there. We'll answer it on air, or give us a call at 521-TALK, 521-8255. We'll be right back.